Hello, this is Bill Scheid from Applied Finance Research with a review of the performance of our monthly asset allocation systems during the COVID crash. If you're not familiar with monthly asset allocation systems, they are designed to help investors profit from market trends by strategically rebalancing portfolios once a month on a monthly basis. These systems are excellent at identifying and capitalizing on major moves in the global markets. And as we're about to see here, they're also excellent at avoiding major bears and market crashes. So what we are looking at here are the results for some of our most popular monthly systems. We have two of our momentum-based systems, BMR21 and then BMR21 with the addition of our volatility stop and optional short positions. Then we have one of our portfolio moving average systems, PMA SPY, and then we have that same system also with volatility stop and shorts. And then finally, we have our hybrid system, which combines momentum and portfolio moving averages into one meta system. And here we've got the volatility stops and optional short positions. What we're looking at are backtest data generated by ETF Replay. Essentially, it's the entire year of 2020 and 2021. Now, on the left, we have data for the S&P 500 buy and hold for this period and buy and hold approach 60/40 stock bonds all world diversified buy and hold approach. The top line numbers are the total return for the 2-year period. And then we have what we're calling crash drawdown percentage. So this is from the 2020 highs to the COVID crash lows of March of 2020, calculated on a month-end basis. And so for the S&P 500, we see that for the 2-year period, it returned 52.4%. But from the highs of 2020 to the bottom of the COVID crash lows in March of 2020, it was minus 19.4%. Now we know that actually the total drawdown of the S&P 500 was closer to 30% in the middle of March, but again, we're looking at a month-end basis here. We have also return to drawdown ratio, and finally the ending balance of $100,000 account, which in the case of the S&P 500 would be $152,400. Now for 60/40 buy and hold, we see that the return is about half of the S&P 500, and the crash drawdown is also about half of the S&P 500. The return to drawdown ratios, of course, are almost the same, and the ending balance of 60/40 is 124,000. Now, looking at BMR21, a couple things to notice here. First of all, the return, 119.7%, absolutely outstanding, more than double the S&P 500, and the maximum or the crash drawdown is only 12.2%. So just a little bit more than half of the S&P 500 and almost the same as 60/40. That gives a return to drawdown ratio of 9.8. So approximately 4 times that of S&P 500 and 60/40. I really like return to drawdown ratio as a metric because to me that tells me the value add of the system that I'm looking at. The ending balance of BMR21, 219,694. Now, when we add the volatility stops and optional short positions to BMR21, we see we get a nice boost in total return from 119 to 144. And very interesting, you'll notice that the crash drawdown number is positive. That means that the system did not lose money during the COVID crash, it made money. It went from losing 12% to making 16.3%, which is a huge difference between the 19% the S&P lost and the 10% that the 60/40 lost. There is no return to drawdown ratio because there wasn't a drawdown, it was actually a positive return, and we get an ending balance of 244,644. Moving on to PMA SPY, that's our portfolio moving average system, we see that the return is 49.6% on a drawdown of only 6.8%. So we made almost the exact same amount as S&P 500, but on a drawdown that's roughly a third. That gives a really nice looking return to drawdown ratio of 7.3 and an ending balance of 149,000. When we add the volatility stops and optional shorts to PMA SPY, we get a return of 48.6. Again, we get a positive number for crash drawdowns. So this system did not lose money during the COVID crash. It made 1.4%, and the ending balance is 148,574. When we look at our hybrid system, which combines momentum and moving average concepts, here we've got the volatility stops and optional short positions added. We have a very strong return, 92.5%. Again, we have a positive number for the crash drawdown. 8.7% was the gain during the COVID crash. Again, we don't have a return to drawdown ratio because there was no drawdown, and our ending balance is 192,491. On the bottom, we have the equity curve for hypothetical $100,000 accounts that would be executed according to each of these strategies here. We have the S&P 500 is the red dashed line, 60/40 is the pink dashed line. We can see that these are the drawdowns that happened during the COVID crash. The only two systems that had drawdowns during this period were BMR 21 and PMA SPY, which basically means 3 out of 5 systems had a positive number for crash drawdowns. That means 3 out of 5 systems didn't lose money during the crash, they made money during the crash. It's also interesting to note that the system with the largest crash drawdown, which was actually only 12.2%, is roughly half of the S&P 500, but it had a return of more than double the S&P 500. The other thing that's interesting about these numbers, when we look at either the equity curve or the data in the table at the top, is we see right away the value add of the volatility stop and optional short positions for both the momentum and the moving average systems. They help the systems go from negative during the COVID crash to positive during the COVID crash, and they also greatly increased the total return in the case of BMR 21. If you would like more information about the courses that we teach on these systems, please visit us at appliedfinanceresearch.com. If you'd like to join our community of traders and investors using these systems, please find us at Patreon, also at appliedfinanceresearch.com. This is Bill Scheid from Applied Finance Research. Thank you very much for watching, and happy investing.